Welcome to the Pro Ticker Deep Dive. It is Wednesday, February 4th, 2026. And if you are staring at your terminal today, watching the indices just sort of grind higher, you might be feeling that strange mix of elation and dread that really defines the specific moment in market history.
It really is a strange feeling.
We are sitting in a pressure cooker. We have a bull market that is, well, it's maturing, but it's not dying, not by a long shot. It's being fueled by an absolute fire hose of AI capital expenditure.
It is the late cycle paradox, isn't it? Everyone keeps waiting for the music to stop, for the party to end.
Yeah, exactly.
But the DJ just keeps loading up the playlist with AI tracks. But, there is a massive collision coming. We aren't just looking at charts today. We are looking at a fundamental clash of civilizations in the digital space.
A clash of civilizations, that sounds dramatic.
Well, it is. On one side, you have this unstoppable force of U.S.-led agentic AI, and we'll get into what that means, but it's software that doesn't just chat, it acts. And on the other side, you have the immovable object of the European regulatory fortress.
Digital sovereignty. That's the phrase of the year in Brussels, isn't it?
It's the only phrase that matters over there right now.
And this isn't just some political headache. It is an existential threat to the balance sheets of some of the biggest companies in our portfolio.
Absolutely.
So today we're going to dissect this collision. We're going to look at the macro setup, this so-called great bifurcation of the software market.
Right. The winners and the losers.
We are going to tear apart the strategies of Salesforce and Zoom as they try to pivot to agents and avatars to survive, frankly.
I fight for relevance.
And we are going to walk through the absolute minefield of the EU Data Act and the collapse of the sovereign cloud myth.
That last part is going to be painful for some listeners to hear, I think, especially if they're sitting on legacy SaaS positions with heavy European exposure.
Why is that?
The game has changed. Borders are back, and not just in the physical world.
All right, let's get into the macro backdrop first then. We have the 2026 equity outlook from Morgan Stanley in front of us, and they are tagging this as a late cycle bull market.
Right.
Now, usually when I hear late cycle, I start looking for the exit. I start thinking about defensive rotations, taking some chips off the table.
That's the textbook move.
But Morgan Stanley seems to be arguing that the party isn't over. They're saying the S&P 500 is going to grind higher. Why? What are they seeing?
Well, Andrew Sliman at Morgan Stanley, he puts it perfectly. He says, late cycle, yes. End of cycle, no.
Okay.
We have to look at the last 3 years. I mean, we have had stellar returns in U.S. equities, just phenomenal. But the texture of this market is incredibly weird.
Weird how?
It is top-heavy
Yeah.
to a degree we haven't seen since the dot-com era, maybe even more concentrated than that.
What are the numbers on that?
The top 10 stocks in the S&P 500 now account for roughly 40% of the total market capitalization.
40% in 10 names. That's terrifying concentration risk.
It's unbelievable.
If one of those pillars cracks, if NVIDIA misses a quarter, or if Microsoft hits some regulatory wall, the whole index just takes a nosedive. How is the market sustaining that kind of imbalance?
Liquidity. Pure and simple.
Okay, but it's not the liquidity of 2020 or 2021, right? The fire hose from the Fed is supposed to be off.
It is and it isn't. The term they're using is stealth quantitative easing.
Hold on. Stealth QE. I watch the Fed announcements. I watch Powell's pressers. They are not announcing bond buying programs.
No, they're not.
They cut rates by 75 basis points last year, and we're expecting, another 50 this year? But that's rate policy, not QE. Where is this stealth QE coming from?
It's in the plumbing of the Treasury market. It's
Okay.
a bit technical, but it is what drives the flows.
Break it down for us.
The Fed is reinvesting the proceeds from its maturing bonds. But instead of letting that money disappear from the system or, buying long-duration bonds like they used to,
Right.
they are heavily rotating into short-term Treasury bills. They're just flooding the short end of the curve with liquidity.
So they are greasing the wheels of the repo market and the money markets without actually expanding the headline balance sheet number. It doesn't show up in the big print.
Exactly. And what that does is it forces investors out of cash. If the short-term yields are being artificially managed and liquidity is just flush everywhere, cash feels like a losing bet. It feels like you're losing purchasing power every day.
So it pushes capital further out on the risk curve.
Right into equities. It's a pro-cyclical liquidity injection that doesn't require a press conference or a big announcement. It just happens in the background.
So the Fed is quietly propping up asset prices while publicly talking about a soft landing. That explains why valuations are remaining so rich. as they say.
It's the only explanation that makes sense.
But let's talk about the valuation picture, because this is where I get stuck. Everyone is screaming, bubble! I mean, my Uber driver asks me about the AI bubble. My dentist asks me about the AI bubble.
And that sentiment, that fear,
Yeah.
is exactly why Morgan Stanley is still bullish. It's the classic wall of worry. When everyone is terrified of a bubble, you rarely get one. A true bubble requires euphoria. It requires that final capitulation where the bears just give up and buy in at the top.
And we are not there.
We're nowhere near there. Because of this bubble obsession, as you call it, valuations for the other 493, the stocks in the S&P 500 that aren't the Magnificent Seven or the top 10 are actually compressed. They're historically cheap in some cases.
So the fear is keeping a lid on the broader market's multiple.
Precisely. The whole AI bubble narrative is acting as a kind of safety valve. It's preventing irrational exuberance from spilling over into the industrial sector, into financials, into healthcare.
And the thesis then is that as AI productivity actually hits the profit and loss statements of these, boring companies,
Right.
helping them cut costs, optimize logistics, automate back offices, their earnings will finally catch up to their stock prices.
That's the whole idea. The other 493 catch up to the Magnificent Seven. The market broadens out.
That's the broadening out thesis. But I have to say, I'm skeptical. I look at the software landscape, specifically SaaS, and I don't see a rising tide lifting all boats. I see a slaughter.
Oh, it's brutal.
Sastra put out this analysis on the new hierarchy of software, and it looks absolutely brutal. It's not a hierarchy, it's a caste system.
It is a caste system, and the great bifurcation is the single most important trend in software investing right now. The middle class of SaaS is dead. You are either a god or you are a peasant. There's no in between.
Okay, so let's break down the gods. Tier 1, the money printers. Who sits here in 2026?
Tier 1 is defined by two things, and you have to have both. AI native and mission critical.
AI native and mission critical.
The poster child right now is Palantir. Just look at their chart. It's up, 165%? Why? Because they aren't selling productivity tools. They are not selling a nicer spreadsheet.
They're selling outcomes.
They're selling outcomes. They are entrenched in government defense contracts and increasingly in enterprise operations where they essentially run the central nervous system of the company.
Yeah.
You cannot rip Palantir out without lobotomizing your entire organization.
That's the key, isn't it? Cannot rip it out, which I guess brings us to Tier 2. The infrastructure. Companies like ServiceNow, Datadog.
Right. Tier 2 is the plumbing, the stuff you can't see, but nothing works without it. If ServiceNow goes down, nobody at a Fortune 500 company can issue a help desk ticket, onboard a new employee, or fix a server. Operations literally halt.
And Datadog.
If Datadog goes dark, you are flying your entire cloud infrastructure completely blind. You have no idea what's happening. These companies have incredible pricing power because the cost of switching isn't just money, it's infinite chaos.
But then we fall off a cliff. We get to what they call Tier 5, post-pandemic normalization. This is the graveyard of the 2021 darlings.
This is where all the pain is concentrated. Companies like DocuSign and, historically Zoom, though they're fighting like crazy to get out of this tier, they sit here.
These were the companies that won the lottery during COVID. Everyone was stuck at home. Everything went digital.
Exactly. But in 2026, the market has realized that e-signature is a feature, not a platform. Video conferencing is a commodity. It's table stakes.
Commoditized. That is the death knell for a tech stock valuation, isn't it? If I can swap you out for a free version from Microsoft or Google with one click, you have no moat. You have no pricing power.
Exactly. And that is why the strategic imperative for 2026 is so stark, so clear. For every software CEO, you must become a mission-critical AI platform.
You can't just be a tool anymore.
You have to move from being a tool that a human uses to an agent that does the work for the human.
Which brings us perfectly to our first deep dive case study, Salesforce. The original CRM giant. I mean, they are fighting tooth and nail to prove they aren't just a bloated database from the 2010s.
We really are.
They are betting the entire company on this concept of agentic AI.
Agentforce. That's the branding. And honestly, they needed this pivot badly. Salesforce was in real danger of becoming the Oracle of the 2020s.
Meaning what? Huge, profitable.
But slow, bloated, and fundamentally unexciting. Just a cash cow. They were trading like a value stock, not a growth tech company.
Right. Goldman Sachs pointed that out in recent notes. Salesforce is priced at a pretty significant discount to its peers. The market is basically saying, show me. They don't believe the AI hype yet.
Not yet. But the Q3 numbers were strong. Revenue up around 9%. Record results. The financials are solid.
The financials are solid, but the story is what matters here. They're trying to shift the entire paradigm of what enterprise software is. For 20 years, software was a tool. You log in, you click buttons, you enter data, you pull a report.
It was a system of record.
Exactly. The agentic shift means the software logs in for you. The software clicks the buttons.
The software does the work.
Let's clarify this for the listener, because agent is rapidly becoming a buzzword like crypto or big data was. It's getting diluted. How is an agent different from the chatbot on my banking app that just frustrates me?
That's a great question. The difference is autonomy and scope. A chatbot is reactive. It's a glorified search bar. You ask, what is my balance? It queries a database and tells you. That's it.
Okay.
An agent is proactive and multi-step. An agent notices, hey, your inventory for Section 123 is running low based on sales velocity. It then checks the supplier's API for lead time. It calculates the optimal reorder amount to avoid a stock out but not overcapitalize.
And then it acts on that information.
It drafts the purchase order. It
Yep.
sends the PO for human approval, or maybe not if it's below a certain threshold. And then it updates the sales team's forecast in Salesforce. It does the job of a junior logistics manager end to end.
Okay, that is compelling. That's a real productivity gain. But we've heard promises of automation for years. Why is it actually working now? And maybe more importantly, why is Salesforce the company to pull it off? Their data architecture has historically been a mess.
A polite word for it.
Right. If I wanted to do AI on Salesforce data in 2023, I had to export it all to a data lake, clean it, transform it, train a model. It was a complete nightmare, an 18-month project.
You have just hit on the single biggest technical hurdle that has held this back. The old way was ETL extract, transform, load. You had to move the data to the AI. That is slow, it's expensive, and it creates massive security and compliance risks.
A data governance nightmare.
Completely. Salesforce has completely re-architected this with a new approach they call federated grounding.
Federated grounding. It sounds like something from Star Trek. Break that down for us. What does it actually mean for a chief information officer?
Think of it like a library. In the old model, the ETL model, if you wanted to read books from 5 different libraries to write a research report,
Right?
you had to physically go to each library, check out the books, truck them all back to your house, and then organize them on your own shelves before you could even start writing.
Yeah.
That's expensive and really slow.
And by the time I get all the books home, the information in one of them might be outdated. A new edition came out.
Exactly. The data is stale. Federated grounding is like having a magical pair of glasses. You sit at your desk, and you can instantly read the books inside all the libraries without ever moving them.
So the AI connects to the data where it lives.
Yes, whether that's in Snowflake, AWS, Google Cloud, or their own data cloud. It's a zero-copy architecture. The AI goes to the data doesn't come to the AI.
That is a massive architectural shift. It removes the single biggest point of friction.
They are lowering the energy of activation for enterprise AI. If a company can deploy a powerful agent without having to build a massive new data pipeline, they will do it tomorrow.
And it seems like they're all in on this. They're buying back their own stock pretty aggressively, which is a big signal of confidence.
And they just bought Informatica to shore up this exact data integration and plumbing capability. It was a strategic, if expensive, move.
So the bull case for Salesforce is that they successfully transition from a system of a glorified Rolodex, basically, to a system of action, a digital workforce that you rent.
If they do that, they re-rate. They go from that Tier 6 value stock category back to Tier 1 mission critical. Because if Salesforce agents are closing 30% of your new business deals, you can never, ever turn off Salesforce.
It becomes the engine of your revenue.
It becomes the company.
Now let's pivot to a company that is in a much more precarious position. Zoom, the verb of the pandemic. They are fighting for their life in Tier 5. They did beat expectations in Q3 fiscal 26. Shares popped a bit, but the underlying story is, well, it's complicated.
It really is a tale of two companies inside one building. You have the online segment, that's consumers, small businesses, the yoga instructors teaching classes from their living room.
The pandemic-era customers.
Right. That revenue is flat. It is stabilized, thankfully, so it's not plummeting anymore, but it isn't growing. The growth is entirely in the enterprise segment. And Eric Yuan knows he cannot build a future on just video calls. It's a suicide mission.
So they are pivoting hard to this idea of workplace elevation. And we have to talk about the demo, the avatar, the digital twin. Eric Yuan showed off this AI avatar that can attend meetings for you. It looks like you, it sounds like you.
It's impressive technology, you have to admit. The realism is getting there.
Is it? Or is it just deeply cynical? I mean, I'm going to push back here a little. If I schedule a meeting with you and I log in and see your digital twin just nodding at me while you're actually out playing golf, I'm not impressed. I'm insulted.
I get it.
Doesn't this just destroy the trust that's essential for business?
That's the visceral human reaction.
Right.
Don't send a bot to do a human's job. And for a one-on-one high-stakes negotiation, you're absolutely right. But look at the data. Executives are drowning in meetings. They are constantly double and triple booked.
That's true. Calendar Tetris is a real thing.
The argument Zoom is making is, what if you could be in two places at once? What if your avatar could sit in the weekly all-hands meeting, digest the information, ask a pre-programmed question you gave it, and then send you the two-paragraph summary, all while you were actually in a different meeting closing a multi-million-dollar deal?
So it's less about replacing the human connection and more about scaling your presence, filtering the noise.
That's the pitch. And frankly, the usage data suggests people want help with this. Their AI companion, which is the less creepy version, just summaries, translations, and action items, has seen a 4x increase in usage year over year.
4 times. Wow.
People are desperate to reduce the cognitive load of just being in back-to-back meetings all day.
Okay, I'll buy the AI companion utility. That makes a lot of sense. But the real business play for Zoom, it seems to me, is the contact center, CKS. They are seeing high double-digit growth there.
This is their smartest play by far. The contact center is sticky. It's mission critical.
Right. Back to our hierarchy.
Exactly. If Zoom runs your customer support lines, handling all your voice, video, and chat interactions with customers, that is a defensible moat. It is much, much harder to rip out than a simple video conferencing license that you could just replace with Microsoft Teams.
But they have a frenemy problem, don't they? They're partnering with Salesforce and ServiceNow, integrating deeply with their platforms. But Salesforce and ServiceNow are also building their own voice and video agents.
It's the classic co-opetition trap, and it's a very dangerous place to be. Zoom is trying to be the Switzerland of video, the neutral platform that integrates with everyone.
Noble goal.
But Salesforce doesn't want to partner. Salesforce wants to own the entire customer interaction end-to-end. Bank of America analysts are rightly worried about this. Can Zoom really remain a neutral platform, or do they just get squeezed out as Salesforce simply adds a Start Video Agent call button right inside the CRM?
And it becomes a feature of the bigger platform.
It gets commoditized again.
And to counter that threat, Zoom is rushing into the channel model. The numbers are pretty stark. 9 out of 10 of their large deals are now partner-driven.
They have to.
Right.
They're trying to get their hooks into the ecosystem through resellers and integrators before the giants can fully mobilize and crush them.
So it's a race. Can Zoom become a full, indispensable communications platform before Microsoft and Salesforce make video a free feature of their own AI agents?
That's the billion-dollar question for them.
So we have these U.S. tech giants Salesforce and Zoom sprinting toward this agentic future. They are building faster, smarter, more autonomous tools. But, as you said at the top, they are sprinting straight into a brick wall.
A very solid brick wall.
And that wall is made of red tape, and it's located in Brussels. Let's talk about the European fortress.
This is the part of the story that U.S. investors, I think, constantly underestimate or just ignore. In 2026, the regulatory landscape in Europe has shifted from being, annoying to being actively hostile to the U.S. tech model.
We've moved past the rule-setting phase.
We have moved from the era of writing the rules, writing the GDPR, writing the AI Act, to the era of active, aggressive enforcement. The regulators have been given their marching orders.
And the nuclear weapon they have deployed, from what I've been reading, is the EU Data Act. I read the summary of this legislation and my jaw just hit the floor. This is being called a game changer for a reason.
It completely upends the fundamental economics of cloud software. The core premise of the Data Act is simple but absolutely revolutionary. The user owns the data.
Okay, but we've heard user ownership before. That was part of the GDPR pitch.
It was, but that was focused on personal data, your name, your email. The Data Act extends this to industrial data.
Yeah.
The data generated by connected products and services, the telemetry from a jet engine, the usage logs from a SaaS platform.
The data that companies use to train their AI models.
The data that creates the value. And the enforcement mechanism here is different. It's all about portability.
Yes. Article 6 and the surrounding provisions regarding switching. Tell us about that.
The Act mandates that cloud providers, that's AWS, Azure, Salesforce, Zoom, all of them, must make it functionally easy to switch to a competitor. They have explicitly banned exit fees.
Which were a huge barrier.
A huge barrier. And crucially, they have mandated a 30-day window for full data portability.
30 days. Let's roleplay this for a second. I'm the CIO of a major German bank. I'm using Salesforce as my core CRM. I decide I want to switch to a European competitor, maybe SAP or some local player.
Right.
In the past, Salesforce could say, sure, you can leave, but it will take 18 months to extract your decade of data. It will cost you $5 million in professional services fees, and the format we give you will be proprietary and useless.
And that creates lock-in. That is the moat. That's what drives the high net dollar retention figures that Wall Street loves so much. The Data Act just destroys that.
So now what happens?
Now, Salesforce is legally required to provide a functional equivalent export of all that data in a standard, interoperable format within 30 days for free.
This just destroys the Hotel California model of SaaS. You can check out anytime you like, and you can actually leave.
You can pack your bags and walk down the street to the new hotel. It turns the SaaS business model from a capture model to a performance model. If your product isn't the absolute best, every single month, the customer can walk away with basically zero friction.
That has to compress margins. It has to increase churn. It's a nightmare for a CFO who relies on those predictable, recurring revenue streams.
It's a total nightmare. And then you layer on top of that the AI Act. We talked about their classification of high-risk AI systems.
Right. What falls into that category?
Anything that has a significant impact on people's lives.
Yep.
So if Salesforce's agent is making decisions about creditworthiness for a loan, or who gets an interview for a job, or how to manage a critical power grid, that is high risk.
And what does that designation mean in practice?
It means it needs mandatory human oversight, rigorous logging of every decision, and this is the really hard part, explainability.
Explainability, meaning you have to be able to explain why the AI made the specific decision it did?
Yes, you have to show your work, which is technically incredibly difficult with many of these deep learning models. If the neural net denies a loan application, often the engineers themselves don't know exactly which node or which weight in the network triggered the final denial.
It's a black box.
It's a black box. But the EU regulators are saying, if you can't explain it, you can't deploy it. End of story.
So U.S. companies are facing a technical barrier with explainability and an economic barrier with churn. But there is a third barrier, and this one is purely geopolitical, the sovereign cloud scandal.
Oh, this is the big one.
The reporting we've seen on this is just stunning. A headline that reads, "Sovereign cloud promises collapsed in court." What happened here?
For the last 5 years, big tech's sales pitch to Europe was sovereign cloud. Microsoft, Amazon, Google, Salesforce, they all spent billions building data centers in Frankfurt, Paris, Dublin.
Right, I've seen the announcements.
And they went to European governments and enterprises and said, your data stays in Europe. It is safe. It is under EU law, safe from the prying eyes of the U.S. government.
Data residency, it's on every single sales slide.
It was a lie. Or, to be more charitable, a legal impossibility. In late 2025, a series of court cases, mostly brought by privacy activists, brought this all to a head.
What did they argue?
They got U.S. tech executives under oath and asked a very simple question. If the U.S. government serves your company a warrant under FISA Section 702, can you refuse to comply because the server holding the data is physically in Germany?
FISA 702, that's the Foreign Intelligence Surveillance Act. It allows the U.S. intelligence community to collect data on non-Americans who are located outside the U.S.
Correct. And it applies to any electronic communication service provider that is subject to U.S. jurisdiction. That includes every single U.S. tech giant, no matter where their servers are.
So what did the executives say in court?
They had to admit the truth. They said, no. If the U.S. Department of Justice demands the data, we have to hand it over. It doesn't matter if the hard drive is physically located in Paris or Timbuktu.
So the physical location of the server is completely irrelevant if the corporate headquarters is in Seattle or San Francisco.
Exactly. And the European courts ruled that data residency provides zero legal protection against the extraterritorial reach of U.S. law. The entire illusion just shattered overnight.
And the fallout has been immediate and severe. We are seeing a massive pullback. I mean, the French government outright banning Microsoft Teams and Zoom.
Yes. The French Digital Ministry issued a formal directive banning the use of Teams and Zoom for all government agencies. They're calling it a matter of national security.
Because they realized their cabinet meetings were essentially available to U.S. intelligence agencies.
They realized that using U.S. tools means the U.S. government has a potential backdoor into their most sensitive conversations. The marketing promises of digital autonomy from big tech are now seen as completely empty.
This sounds like an unbelievable opportunity for European tech companies.
It is the biggest tailwind for the European local cloud industry in history. Companies like OVH Cloud in France or Deutsche Telekom's cloud in Germany, they're seeing a massive resurgence.
Why? What's their unique selling point?
Their unique selling point is that they are not American. They can go to the French government and legally promise. The NSA cannot subpoena us under FISA. That is a guarantee that Microsoft can never, ever match.
So how do Salesforce and Zoom respond to this? They can't just abandon the European market. It's way too big.
They are trying to patch the problem with technology and clever marketing. Salesforce, for example, launched the Hyperforce EU operating zone.
Hyperforce. It sounds like a Power Rangers team or something. What does it actually do?
It's an attempt to ring-fence the operations. They guarantee 24/7 customer and technical support from EU personnel only, so no U.S. support staff can touch the tickets or access the systems.
Okay, that's something.
They're using advanced encryption, where supposedly Salesforce US doesn't hold the keys. And they are leaning heavily on that federated grounding architecture to say, look, the AI model runs in the US, but it only reads your data. It doesn't store your data there.
But is it enough to satisfy the courts and the regulators?
It's a Band-Aid, a
Yeah.
clever technical workaround. But the fundamental legal reality hasn't changed. As long as Salesforce Inc. in Delaware is the parent company, the risk remains.
And Zoom is doing something similar.
Same playbook. They're opening a dedicated UK data center, trying to segment their European traffic from their US traffic. They are trying to prove they respect data residency, even if they can't legally guarantee data sovereignty. But the trust is broken.
Which brings us to the core investment implication. You called it the regulatory discount at the start.
Yes, if you are a U.S. investor valuing these companies, you have to apply discount to their European operations.
Yeah.
You have to assume that their growth in Europe, which is roughly 30% of the global software market, is going to be structurally lower and more expensive than their growth in the U.S. or Asia.
Lower and more expensive. Why?
They have to run dual stacks of infrastructure. They have constant legal battles. They're going to face higher churn because of the Data Act. $1 of revenue earned in Europe is now worth less than $1 of revenue earned in Ohio because the European dollar is simply harder to earn and harder to keep.
So we are moving inexorably toward the splinternet, a bipolar or multipolar digital world.
We are already there. It's not a future prediction. It's the reality of 2026. We had the U.S. stack. It's fast. It's largely deregulated. It's agentic. It runs on the hyperscalers. And we have the EU stack. It's private by design. It's sovereign. It's slower. It runs on local certified clouds. And it has human-in-the-loop mandates.
That sounds incredibly inefficient for a global corporation. If I'm a company like Toyota or Siemens or General Electric, do I really have to buy two completely different sets of software?
Yes, that's what's happening. You essentially run a bifurcated IT strategy. You use the high-speed autonomous AI tools in your U.S. and Asian offices to stay competitive on a global scale. And you use the lockdown, compliant but less advanced tools in your European offices to stay legal.
It must destroy margins. It creates data silos all over again.
It does. But it is the cost of doing business in 2026. Regulatory compliance is now a line item on the IT budget.
Before we wrap up, let's look ahead. We've painted a picture of a tense, bifurcated world. What are the specific risks that could derail this late-cycle bull market in the next 10 months or so?
Well, the most obvious one is political. 2026 is a midterm election year in the U.S. The market hates uncertainty, and midterms almost always bring a correction in Q2 or Q3. It's just a historical pattern.
But what's the specific policy flavor this year?
The policy flavor is affordability politics.
We're seeing this from both parties, aren't we? Populism is the word of the day.
It is. We are seeing serious proposals to cap credit card interest rates, to crack down on corporate price gouging, even discussions around rent controls at a federal level.
These are policies that pull very well with voters who are just tired of inflation and high costs.
They pull incredibly well, but they are poison for corporate earnings. If you cap a company's pricing power, you absolutely crush their margins. The market has not priced this risk in at all.
And then there is the geopolitical powder keg. You mentioned earlier, the sources point to tension in places like Greenland and Iran.
Iran is the perennial flashpoint for energy prices. That's not new. If that situation escalates, oil spikes, and the Fed's soft landing narrative turns into a stagflation nightmare very quickly.
But Greenland is the interesting one. Why Greenland?
2 reasons: rare earth minerals and shipping lanes. As the Arctic ice melts, New, shorter trade routes between Asia and Europe are opening up for the first time in human history.
The Northwest Passage.
Exactly. And Greenland sits right on top of those routes, and it also has massive untapped deposits of the rare earth minerals needed for all these AI chips. The US and China are jostling for influence there in a big way. It sounds like a fringe issue, but a skirmish over Arctic access could disrupt global logistics faster than people realize.
So let's bring it all home. We've covered the stealth QE, keeping the market aloft. We've covered the great bifurcation of SaaS. We've covered the desperate agentic pivots of Salesforce and Zoom. And we've covered the rise of the European fortress. What is the ultimate takeaway for the listener?
The takeaway is that we are living in a time of profound contradictions. The technology is trying to unify the world. You have AI agents connecting everything, AI models understanding every language. But the politics is tearing the world apart. Data acts, sovereign clouds, outright bans on technology.
And as an investor or a business leader, you have to operate in that gap. You have to constantly ask yourself, is my software stack mission critical enough to survive both commoditization and regulation?
Is my portfolio overexposed to that commodity tier of SaaS that is about to get completely wiped out?
It's a challenging environment.
It is. And here's a final provocative thought to leave you with. We talked about agents doing our work. If the U.S. economy becomes fully agentic, running at the speed of Silicon 2047, with autonomous entities making deals, and Europe remains human-centric, running at the speed of bureaucracy and privacy compliance reviews, do we end up with two completely different speeds of economic evolution?
Does the U.S. accelerate into some kind of sci-fi future while Europe becomes a boutique museum of privacy?
Or, to play devil's advocate, does the U.S. careen into an AI-driven disaster of mass hallucinations and algorithmic flash crashes, while Europe remains the only stable, human-verified, and trustworthy economy left on the planet?
And if the courts are right, and sovereign cloud really is a myth, is any of your data actually safe, or is it just being leased to the highest bidder with a government badge?
That is something to mull over while you check your cloud subscriptions.
Thank you for listening to the ProTicker Deep Dive. We'll catch you next time.
Goodbye.